In this video, I will discuss changes in reporting entity and a few wrap-up topics related to accounting for changes generally. In previous videos, we have discussed changes in accounting principle and accounting estimate. Next, we will talk about changes in reporting entity. A change in reporting entity occurs when a company acquires a new company through a merger, disposes of a subsidiary through its sale, or otherwise changes the composition of the entities being rolled up into a single set of financial statements. In other words, the same transactions will be accounted for in the same way, but grouped with a different set of transactions representing the new entity. Changing the method of accounting for a subsidiary, something we will learn about later in this course, is also considered a change in reporting entity. It's also kind of a change in accounting principle, but that doesn't matter because both are accounted for using the retrospective approach. We already learned the retrospective approach in a previous video, but its application to change in reporting entity is complex. So for now, you will not be asked to prepare any journal entries related to a change in entity. Now that we've talked about all three types of accounting changes, let's consider a few more general items regarding all types of accounting changes. So far, all the effects we have talked about are direct effects. To switch from LIFO to FIFO, we made a journal entry that impacted the inventory, deferred tax liability, and retained earnings accounts. To switch from completed contract to percentage of completion, we made a journal entry that impacted the construction in process, deferred tax liability, and retained earnings accounts. These were all direct effects. There can also be indirect effects when current or future cash flows depend upon the reported financial statements, such as employee profit sharing that is calculated as a percentage of reported income. When there is an indirect effect, the cumulative effect is reported in the current period. Using profit sharing as an example, let's say that last year a company made $100 million and paid out $1 million to its employees as profit sharing. The company then made a change in accounting principle that increased the prior year reported net income to $200 million. Had the company been using that reporting all along, the employees would have received an additional $1 million. How do you think the employees are going to feel about being shorted that money? I think that's probably a bit of an understatement, Annabelle. So the company will go ahead and pay their employees that extra $1 million, reported as an expense in the current period, to avoid any riots. Now imagine that the accounting change had the opposite effect and the employees received too much profit sharing. Do I have any volunteers to go ask for that money back? Chloe? Well, Chloe always has selective hearing, but this time she has a point. No, management isn't going to go ask for that money back, so no entry would be required. So why do companies make accounting changes in the first place? Sometimes the change is required by law. For example, when the FASB issues a new standard that replaces an old standard, that would be a required accounting change. When an accounting change is optional, however, management should be making the change because the new information, rules, or transactions make it clear that there's a better way to represent the company's performance. Unfortunately, management can also take advantage of accounting changes for a few more nefarious reasons. Accounting changes can be used to manage earnings in a way that does not represent the true performance of the company, but instead fulfilling some other purpose. When we typically think of managing earnings to increase their profits, management might also manage earnings downward in order to avoid regulatory attention. Management also has to be very concerned about making their debt covenants. A debt covenant is a rule that is placed upon a company when they take out a loan, stating that they must maintain certain financial ratios or the loan becomes callable or repayable immediately. Companies do not keep enough cash on hand to repay all of their long-term debts, so this could be particularly detrimental to a company. Management also has incentive to manage earnings such that they receive any bonus payments that are based upon meeting earnings thresholds. Finally, management has incentive to use accounting changes to smooth earnings and report the steady growth rather than the steady growth that investors prefer over the more volatile earnings that it might be more realistic. This concludes our lecture on changes in reporting entity and accounting for changes wrap-up. Don't forget to email any questions for our discussion.